Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said, "Millionaires don't need astrologers, but billionaires do." And so we begin. Today is Friday, March 22nd, 2024. I generally like to start by looking at the S&P 500 just because it's really the easiest, best benchmark as to see what the stock market is doing. And we ticked down a little bit. As I said yesterday, we bumped our head on here and we're likely to head lower here. I still think that we are going to go bearish for all of the reasons that I've been talking about in previous shows. Taking a look at the Qs actually ended slightly higher than yesterday's close, but nowhere, we didn't even go near yesterday's high. I still expect this to go down. I'm still short the Qs. I'm going to be holding this position until it breaks down. I strongly think that we're going to be breaking down here for a whole bunch of reasons that I've been discussing on the show, and that hasn't changed. On the VIX, one thing to notice is, I had talked about we broke through this trend line, and it looks like we're stopping here. We're not continuing lower, and when the VIX is going up, that's when volatility, stocks are moving very quickly, and they're not moving as quickly right now, and so it's allowed to be a little suppressed. I do expect this to tick right back up. Big wicks on candles oftentimes indicate pretty big reversals. I mean, if you just even take a look at this chart right here, some of these biggest candles, the having a very large wick, just if you're not aware already, the opening of a green candle is at the bottom of the candle, the closing is at the top. So during the day, it started there and it ended there, and during the day went all the way up to there and all the way down to there. That's what the wicks are for. And so when you have a big wick, it means that it tried to go up and then it's like it failed miserably, and that oftentimes leads to a reversal. And these big wicks on the VIX, I'm a bear, and that's not going to be changing, not yet. So HYT, high yield corporate, did not move at all today. Again, as I had been talking about in yesterday's show, it seems to me the best way of looking at this that I see is smart money is just sitting on their hands waiting for something to happen. It's like it's waiting for something to happen. It's waiting for the stock market to start ripping higher, and expectations of inflation to keep going up, and the economy to keep going on, which I don't believe. I don't think that's going to be happening. I don't think that's where we are. I think for many, many reasons, including overvaluation of stocks, including the fact that we went through a hiking cycle, that we're pausing, that we're talking about cutting, all of these things indicate that we are basically at a top in especially the S&P 500 and the triple Qs, and I think that will be reflected in high yield corporate pretty soon as well, when bankruptcy risk starts going up. Now, some important things going on in the dollar. This is a daily chart. Now, if you remember, on Wednesday it was going up. Thursday was the Fed decision, and it had dropped, but I follow, one of the other people I follow is Ira Epstein on his channel. He's like in his 80s. He's been doing markets like 14 hours a day for the past 56 years. He has a lot of wisdom to share, and it's incredible some of the things that you can pull out of what he says about macro views especially. And One of the things regarding as to what's going on here is, the American markets saw a dovish Fed, and we're like, okay, well, that means that automatically the dollar is weaker, and it went down. But then overnight, the Asian markets, the European markets, apparently there were some other big events in announcements of central banks. I think a Swiss central bank as well as an Australian central bank. Anyway, all of these central banks are sort of following what the Fed is saying. And so the way this is apparently working is that when the dollar is stronger, when the dollar is stronger to other currencies, that's, that coincides with more hawkishness. It's weaker when there's more dovishness. But if other currencies are also more dovish, the US dollar still reigns supreme. And so if everybody's on equal ground and everybody's dovish at the same time, the world reserve currency, the US dollar, is the strong player here. And he called that out beautifully. And as you can see, the FOMC decision was Wednesday, not Thursday. And then Thursday we had the pop, and then we had a follow through today, Friday, the dollar going higher. Now, funny enough, when the dollar goes up in value, that does put downward pressure on stock valuations as well. And so this, I don't know. I see my crystal ball. We're still at a top. It's a top. I'm staying short with 5% of my portfolio. Even if we stay flat for a while, I'll see it as an opportunity maybe to get out of some positions, especially if my other positions continue to do well for a week or so, or really well, take the gains and run. At the end of the day, money market funds are still yielding today, 4.5%. The Fed funds futures rate is between 5.25 and 5.5% right now. So, cash in this environment is not trash. It's just not trash. It has, the yield on it's better than what you can expect from a return from most value stocks. Anyway, I digress. Let's move on to the rest of the charts. I wanted to point out the U.S. Treasury's yield curve. This is, what's going on in the secondary market. So you have the Fed funds futures, which is a future where there are futures contracts based on the probabilities of they help predict the Fed funds futures probabilities, but that's different from the actual U.S. Treasury yield curve. And so finally, I had, if we go back a few days, we had seen sort of uninversion, sort of flat, but now we're seeing a little bit more decisive inversion going on, where we have the 1 month clearly higher than the 2 month and the 3 month and going downward. And so, the secondary market, in other words, is more surely pricing in cuts coming soon, and then accelerating, after, that's not really an acceleration because that's 6 months here. That's the problem with this chart. It doesn't show the length, right? Like 20 to 30 years is not the same as 1 month to 2 months. So it really should be spread out here more. It's a little deceptive the way this chart looks, actually. It's good to realize when you're looking at it. Moving on, again, I digress. So the TYX 30-year Treasury yield dropped pretty significantly today. We had a bit of a gap down. I found this to be interesting. you know, it's starting to resemble a very clear pattern here. This is not very hard to see at this point. If I just take my doodle and I draw this, I mean, come on. What is this? What is this pattern here? Say it with me. This is a bear flag. So you have the pole here, right? And this is a very clear channel. And so if the next time we get to the bottom of this channel, if we break through, we can expect this pole, you know, to go down to about there. And so, you know, probability wise, it looks like 30-year Treasury yields are headed lower. That's what this pattern looks like to me. I have 40% of my portfolio in long duration Treasuries, a fund called ZROZ. And so the only reason I don't have 100% in it is because the yield curve is still inverted. And, you know, strange things can happen while we're still inverted. The stock market crash usually happens when we actually uninvert, and, you know, we haven't uninverted, but there's seeing the valuations going where they have and seeing, just putting the whole picture together. I think the crash is coming earlier than we think. I think also, you know, when they come out with revised numbers of all the data coming out now, later, you know, we might be in a recession right now. You know, part of all of this game too is making everything look good before elections, and then after the elections we can be like, oh, by the way, we're in a recession and everything stinks, and, you know, the Fed can come out and be like, oh, you know what, we made a cut and we're seeing inflation go back up, so we're going to raise by 50 basis points, and then everything crashes. You know, who knows what's going to happen? I mean, it's not like I'm the guy with a crystal ball, so what's going to happen? I think, I don't know, it looks like I'm seeing yields go down in the long end of the curve. I'm seeing triple Qs and S&P 500 peaking out here, and I think we're due for at least a pretty big correction right now, at the very least. You know, this might not be the end. This might not be like the big crash that inevitably is coming, but yeah. That's all I have for you today. Hope you enjoyed the show. Thank you for watching. Robschild.